Hey folks, Frank Zorrilla here, the 9th of September 2019. Want to do a quick video in regards to the indices or the ETFs, all right? We mentioned in the room the other day that, or I mentioned in the room the other day that I own the indices, the SPY, the Qs, the IWM as core holdings, meaning that I own them forever. And the only thing that changes is just the allocation to these holdings throughout the months, throughout the years. But before we get started, let me just mention that I truly believe that we don't trade the markets, we trade our beliefs about the market. Okay? So you don't have to agree with everything that I say, and agreement is not mandatory. But what you want to do is you want to make sure that your beliefs are pretty much, the same or they match how the market actually works. Okay, we might have a certain belief because we read something that only stocks near 52-week highs go up, so you only could buy those, right? That's a belief, right? So you need to make sure that you go on to your system, to your software, and you double check that. You might believe that only stocks that are trading near lows are the ones where you can make money on, right? So you go to your system and you look at the best performing stocks within your time frame, and you double check that to see if it's true or not. Okay, so that's number one. Number two, the indices, the S&P 500 has a tendency to move higher over time. Okay, that means that the most important thing is time. The more time you have, the better, the bigger the chances that you're going to make money if you own the S&P 500. As you can see here, this chart, 1926 to 2014, 24 negative years, 65 positive years. Okay, that's big. That's 73% of the times that the market has gone higher. Okay, here's a different chart. The average bull market lasted 8.9 years. The average bear market lasted 1.3 years. And you can see here 3.7 years, 13.9 years, 15 years, whatever. So within these bull markets, it doesn't mean that you're not going to have drawdowns. It doesn't mean the market's not going to go down 12, 15, 16%, 10% multiple times throughout the years. That's going to happen. It just tells you that the market has spent more time going higher than going lower. That's clear from here. Okay, and there's obviously no guarantee that past performance will turn out to be the same in the future, but this is just, you need to know your history. And very simply, a bull market is over when the market has fallen 20% or more. All right, so you can see here again, the bull markets have lasted a long time. The bear markets have lasted not that long. But you're going to have some intra-year drawdowns, up to 20%. That might be a little scary. And that brings me to the next chart, which is this one here. The S&P 500, the average intra-year decline for the last 39 years has been 14%. Some years more than other, but it's 14%. And every time there's some reason that we've never heard of before that sounds really scary, but whatever it is, that should be expected. When you get involved in the market, you should have some type of idea or expectation that at some point you're going to have a drawdown, and that average drawdown for the S&P 500 has been 14%. And I don't think many people realize that. People see the S&P 500 and they see the returns. Oh, I could have just bought the S&P 500. I would have done great. Right. But the problem is when you get that 14% drawdown and you're on Twitter and you have market in turmoil, you got this president, whatever the case may be, and you got all these stories. North Korea is going to throw a nuclear bomb. We have Ebola. Whether you hold or not through that period, that's what really counts. All right. So, but with that being said, the average decline has been 14 years. And although we had that average intra-year decline of 14%, the market has been positive those calendar years, 29 out of 39 years, which is roughly 74%. So to reiterate, the indices have a tendency to move higher over time. So time is the most important factor here. The more time you have, the better it is. But be aware that you're going to have these intra-year drawdowns that might look scary. We just had one recently in the fourth quarter. The S&P 500 was down, whatever it was, 20%. That was big, okay? So for me, the only thing that changes is that as the market moves lower and we get close to that average intra-year decline, my allocation to these indices, to these ETFs increases, okay? So let me give you a perfect example. Right over here, I was probably maybe 10% in the indices. My allocation to them was probably 10, 12, 13%. Once we got down here, December 24th, whatever it is, December 25th, my allocation was up to 50 to 55%. I was doing less stock trading and more index buying. As we got oversold, I was buying more, and more. Once we got the rebound, I started trimming that fat. And I went down from 55 to maybe roughly 20 to 30%. I forget what it is right now exactly, but that's how I trim my allocation, and I either trim or increase my allocation. As we get down to those intra-year decline levels, I'm buying more. As the market rebounds and we start to get extended, I'm selling. And then I'm buying back on dips, but I'm always holding on to a piece. And I think it's important. It's important because there's certain times where, again, I don't believe that you should be swing trading your entire account in individual names. I know swing traders that go from, 100% invested to 100% cash, back to 100% invested. That doesn't work for me, okay? Because there's certain times that you're not going to be in tune with the market. There's certain times that the S&P is going up, and most individual stocks are not doing well. We saw that, I think, back in 2013 or 2016. The S&P is going up, but breadth, was horrible. Only 4 or 5 stocks were driving the market higher. That happens sometimes. So you want to own a piece of the S&P 500. You want to own the market. Number 2, you might have situations like we had here when the market goes up 4%, but individual names are not really doing well. And you don't want to find yourself, behind the 8 ball, looking for ideas when things are not working. But if you own the S&P 500, you're going to participate. You're going to have some participation, and that's going to make you psychologically, you're going to feel better, and you won't be out there looking to make something happen when there's nothing to make happen, okay? Number 3, by owning the S&P 500, the QQQs, the Dow Jones, the IWM, you're going to own a piece of the biggest winners, of the biggest long-term winners, always. That means Cisco, Microsoft, Home Depot, Apple, Google. You're going to own a piece of all those big winners. Not only are you going to own a piece, but they're going to be easier for you to hold. All right? Because they're pretty much part of an index, part of the S&P 500. All right? People you always see on Twitter, had you invested $10,000 in Amazon and be worth whatever now? The point is that Amazon has some tremendous drawdowns. That 99.9% of those individual traders would not be able to withstand a 50, 70, 80% drawdown that Amazon had. So did Netflix. But when you own them as part of an index, it doesn't affect you at all. Okay? Because if Amazon's not working, maybe something else is working, okay? Number 3, the indices have, like I said before, they have a tendency to move higher over time. Individual stocks is a different story. There was a study done years ago by Matt Faber with the Russell 3000 stocks, and about 80% of the Russell 3000 stocks throughout their lifetime had a negative return, okay? 80%. So if you wanted to hold something for the long term, I believe now holding on to the indices or to an index is a lot easier than holding on to individual common stocks, because things change for individual companies. Their business, might change. If you look at some of the, companies that were big winners before, Compaq Computers, Tandy, BlackBerry. Things change. By owning the S&P 500, you're going to get a piece of those new up-and-coming companies that turn out to be long-term winners. So, as far as when is the right time to buy the S&P, look, we always want to, get involved. If you don't own the S&P 500, you want to get involved. You want to get involved in a situation like this, like in December when we were down 20%, right? But let's say right now you wanted to get involved. There is no right time, in my opinion. Anytime that I get a new client into the firm, within those first 5 days, I'm buying a piece of the S&P 500. It might only be a 1% allocation, but I'm buying a piece, okay? With the thinking that I'm going to buy more on a pullback. Okay, so I don't think there's a right time or the wrong time. I just think that you need to own a piece and understand that what you're looking for is the opportunity to buy more. And when you buy more, you're going to buy more on the way down. When I talk to someone who's just starting a new job, he's got a 401k, the first thing I tell him is very simply, if you get a chance to buy the S&P 500, the Qs or the IWM, buy that. Okay? You can put, depending how old you are, you can put 75% of the money that's taken out of your check into that index, and you just buy it every single month or every 2 weeks, whatever the case may be, and you leave 25% in cash. All right, that 25% in cash, what you're going to do is you're going to use it when the S&P 500 gets down to those intra-year levels and the market and the world's coming to an end and the market is going down. We're down 15, 20%. That's when you take all that extra cash that you kept in cash, that 25%, you put that all together and you buy a big chunk. Okay? So to reiterate, the market has a tendency to move higher over time. So you want to own the S&P 500. By owning the S&P 500, you're going to own a piece of all the biggest winners throughout history, okay? Not the short-term winners. I'm talking about the long-term winners, Google, Amazon, Home Depot, those type of things. Not the ones that go up for a year and then go down, but the big ones. Number 3, I think if you're trading for a living, I think owning the S&P 500 is extremely, extremely important. You're going to participate when the market goes up. Those times where you're not in tune with the market, it's going to be okay because you own a piece of the market. You own a piece of the S&P 500. Believe it or not, nowadays, it doesn't matter how well you educate yourself. At some point, you're going to judge yourself based on the S&P 500. That's just a fact. So, own a piece of it. And number four, never forget about those intra-year declines. Okay? They always happen. And they always happen for different reasons, and those reasons might be scary. And the way news is being delivered nowadays, they make everything more than it is. The higher the VIX, the higher the clicks, the higher the views. So they make everything seem a lot worse than what it is. So understand that throughout the years, we always had an issue why the market should be going down. Oil embargo, assassination of JFK, Ebola, North Korea, Greece, China, president, everything, okay? But just understand that the most important thing here is time. And if you have time, if time is on your side, then history has shown that the market has a tendency to move higher over time. If you're able to allocate more money and average down on the S&P 500 when we get down to those intra-year levels, then that's even better. Okay, I think the S&P 500 and the indices, you want to own them on the way down, not, here, like when people say, oh, we're breaking a new high, we got a clear signal. No. You had a clear signal here, no resistance. Okay, here's what happened. Here, no resistance. Here's what happened. Here, no resistance. Here's what happened. You want to buy these things on the way down. You want to remember about those intra-year declines, and you want to buy more as we go down. Once the allocation gets a little too fat, we get the rebound, and you want to trim that fat and then do it all over again. You can trim the fat. You can sell calls against it, which is also a good idea. And you know, I wouldn't buy puts, but I would either trim the fat or sell calls against it. Okay, I hope this video helps. If you have any questions, just leave them, either email me or leave it in the room. Thanks.